95% of traders lose their money in the market. Is it because they don't have a good strategy? Or is their luck bad? The truth is that neither of these things is true. There are some people in this world for whom making money is a habit. A trader whose winning rate is 99%, a person who turned $25,000 into $80 million, and a genius who built a multi-million-dollar empire by screaming in the pit. The world calls them market wizards. Jack Schwager's book is not a story, it is the key to those secret doors that big hedge fund managers keep hidden from you. In today's video, we are going to completely decode the minds of the legends of the stock market. And believe me, by the time you reach the end of this video, the way you look at the market will have changed forever.
Part 1. Futures and Currencies. This part has chapters on those 5 legends who ruled the market where 90% of people lose their capital. Chapter 1. Michael Marcus, Millions of Dollars After Early Failures. Michael Marcus's story is the biggest inspiration for a trader because after his early failures, he turned $30,000 into $80 million in 10 years. The secret of his success was not just charts, but his strict discipline and way of thinking. Michael Marcus started out as a very bad trader and went completely broke many times. In the beginning, he even lost money borrowed from his mother because he was trusting other people's tips without any plan. His luck changed when he met the famous trader Ed Seykota, who taught him that you should not fight the market, but go with the trend. In the book, Marcus described 3 main keys for a successful trade, which must be present together. First key, fundamentals. Just looking at charts was not enough for Marcus. He would first look at what the real mathematics of demand and supply in the market was. He believed that behind every big change, there is a solid economic reason. If you are trading in corn or the dollar, you should know whether there is actually going to be a shortage of them or whether the stock is too high. Trading without understanding the fundamentals is like shooting arrows in the dark. Second key, technical analysis. Marcus learned from Ed Seykota that charts are a mirror of the market's movement. Fundamentals can tell you what should happen, but technicals tell you what is happening. He always went with the trend. He would only buy when the price on the chart was constantly touching new highs. For him, charts were like a safety shield that ensured he did not swim against the wave of the market. Third key, market tone. This was Marcus's most unique and secret strategy. Market tone means the market's reaction to news. Marcus explained to Jack Schwager that if very bad news comes in the market, and despite that prices do not fall, that is a very big signal. It means that the market is so internally strong, bullish, that no news can bring it down now. Similarly, if the market does not rise even when good news comes, understand that a fall is coming. Marcus's attitude towards risk management was very strict. His biggest mantra was, cut losing trades quickly and let winning trades run long. He always kept his stop loss predetermined so that no single loss could take him out of the market. He warned that if you are risking more than 5% of your total capital in one trade, you are making a very big mistake. Finally, Marcus believed that trading is entirely a game of self-confidence. Trading on someone else's tip is the most dangerous thing because when the market goes against you, you will have no logic of your own to exit. He would wait for hours until all 3 of his rules fit together at the same time because patience is the thing that turns an ordinary trader into a market wizard. Chapter 2. Bruce Kovner, the master of macro trading. This is the story of a man who was considered the biggest player in the interbank currency market. Bruce Kovner, who had learned trading from the hero of the first chapter, Michael Marcus, later went far ahead of him. Beginning and development. Bruce Kovner's beginning was very interesting. He had not started trading until the age of 31. Before that, he drove taxis and was a student of political science. He took his first trade with a $3,000 credit card loan. In the beginning, he made heavy profits, but when the market went against him, he panicked and exited very quickly. This experience taught him the biggest lesson of risk management. Main trading principles. 1. Combination of fundamentals and technical. Kovner believed that no big change in the market happens without a reason. He always tried to understand the fundamentals first, but he also said that technical analysis is like a radar that tells you that something big is about to happen in the market, even if you don't know the reason yet. 2. The iron rule of risk management. According to Kovner, a successful trader is one who knows how to lose. He had two main rules of risk management. Decide exit point first. Kovner used to say, "Before taking a trade, I already decide where I will exit." If the market reaches that point, he would cut the trade without thinking. Position sizing. He never put all his capital in one trade. He said that your position should be small enough that if your stop loss gets hit, you don't feel emotional pain. 3. Psychology of the market and discipline. Kovner told Jack Schwager that most traders fail because they want to run the market according to their own wish. He used to say, "The market will do what it has to do. Your job is just to follow it." He credited his success to discipline and objectivity where there was no room for emotions. Special strategy, global macro trading. Kovner was a global macro trader, which means he kept an eye on the entire world's economy, interest rates, and political turmoil. He would see what effect an event in one country would have on the currency of another country.
Chapter 3. Richard Dennis, father of turtle traders and legend of trend following. Richard Dennis, who was called the Prince of the Pits, started with just $400 and turned it into a vast empire of $200 million. His biggest specialty was his unshakable belief that trading is a learnable art. This thinking gave birth to the turtle traders experiment. Richard Dennis, the story of the father of turtle traders. Richard Dennis believed that successful trading does not require any special talent or sixth sense, but is only about following strict rules. To prove this very claim, he made a bet with his friend William Eckhardt and selected 23 ordinary people. Among them was an actor and a game designer. He gave them only 2 weeks of training and then gave them millions of dollars to trade. The results were shocking. Those turtles made more than $100 million in profits in the next few years. The magic of trend following. Richard Dennis's entire strategy was based on a simple idea: go with the wave of the market. He never tried to guess where the market would go. His rule was clear: if the market is going up, buy. If it is going down, sell. He used to say that a trader should not think that this stock has become very expensive, because a real trend can stretch much longer than you think. Richard Dennis's unbreakable rules of trading. 1. Small losses and big profits. Dennis used to say that 95% of profits in trading come from only 5% of trades. The rest of the time, you either bear small losses or stay in marginal profits. The main part of his strategy was that when you are losing, exit immediately, but when you are winning, squeeze that trend all the way to the end. 2. Position sizing and volatility. Dennis taught his turtle traders to decide the size of the trade according to the market's turbulence or volatility. If the market is moving up and down a lot, take a small position. If the market is calm and stable, take a big position. This way, you do not get knocked out of the market in one single blow. 3. Discipline. In the interview, Dennis told Jack Schwager that making the rules of trading is 10% of the work, while sticking to those rules is 90% of the work. He said, "Most people will not be able to succeed even after reading my rules in a newspaper because they will get scared when the market goes against them." The biggest lesson: killing your emotions. According to Richard Dennis, a trader's biggest enemy is his own fear and greed. He used to say that you should trade like a machine. If your system is giving a sell signal, you should sell it without thinking about what will happen tomorrow.
Chapter 4. Paul Tudor Jones, the man who predicted the 1987 market crash. This is the story of the world's most aggressive and energetic trader, Paul Tudor Jones. During the 1987 Black Monday crash, when the whole world was going broke, he shocked everyone by earning a 62% return with his strategy. His story is that of a warrior who steps into the market every day fully prepared to fight. Paul Tudor Jones, that famous prophet of market crashes. Paul Tudor Jones' trading style is very defensive, even though he appears very aggressive. He told Jack Schwager that his biggest secret of success is that he focuses more on protecting money from being lost rather than making it. That famous prediction of the 1987 market crash. Jones had seen the 1987 market crash coming before it arrived. He and his partner, Peter Borish, compared the charts of the Great Depression of 1929 with the charts of 1987. They saw that the movement of both markets was the same. When everyone else was hoping that the market would go even higher, Jones built a heavy short position. The result? When the market fell, he made millions of dollars overnight. Paul Tudor Jones' core trading mantras. Number 1. Throw your ego out the window. Jones used to say that your biggest enemy in trading is your ego. If you have taken a wrong trade and the market is going against you, do not hope, exit immediately. He used to say that he has no shame in being wrong, because being wrong is human, but staying wrong is stupidity. Risk management, the mathematics of 5 to 1. Jones followed a very special risk-reward ratio, 5 to 1. This means he looked for an opportunity to earn $5 on a risk of $1. He believed that even if you are wrong 4 out of 5 times and right only 1 time, you will still not be in a loss. He never put all his capital at stake in any one trade. The market's mood and the 200-day moving average. Jones has a very famous technique, the 200-day moving average. He used to say, "My biggest rule is that I never touch a stock that is trading below its 200-day average." For him, this was the line that must not be crossed. If the market is below this line, he would only look towards the bearish, short side. Starting every day at 0. The most unique thing about Jones was that every morning he would look at his position as if he had just taken it today. He would ask himself, if I did not have this position today, would I buy it at the current price? If the answer was no, he would immediately close that trade, whether he was in profit or loss. Mental discipline and the spirit of the game. Jones had been a boxer, and he saw trading as a match as well. He believed that you have to stay alert at all times. He used to say, never think in the market that you are very good. The day overconfidence replaces confidence in you, the market will knock you down to the ground. Chapter 5. Gary Bielfeldt, expert in U.S. Treasury bond trading. This is the story of a trader who ruled the world's biggest and most difficult market, U.S. Treasury bonds. Gary Bielfeldt started with just $1,000 and became the biggest individual trader at the Chicago Board of Trade. The most special thing about his trading style was that he was also an excellent poker player, and he made millions of dollars by applying the principles of poker to trading. Gary Bielfeldt, the uncrowned king of the bond market. Gary Bielfeldt's story is that of a person who was very calm and disciplined. He told Jack Schwager that there are many similarities between trading and poker. In both, you have to know when to place big bets and when to fold your cards and exit the cards. The unique connection between poker and trading. Gary believed that to become a successful trader, you need to have a winner's psychology. He explained that, waiting for the cards. Just as in poker you do not place a bet until you have good cards, similarly in trading, wait until the market is in your favor. Understanding the odds. He always worked on mathematical probabilities. If the chances of winning are low, he would take a small trade or not trade at all. Gary Bielfeldt's main trading principles. 1. Learning from your mistakes or analysis of failure. Gary told Jack Schwager that he would deeply analyze every losing trade. He would not look at what the market did, but at where did I go wrong. According to him, the path to success in trading passes through the correction of your own mistakes. 2. Selection of the best trade, or selection is key. Gary's rule was very strict. Only trade when both the market trend and fundamentals are with you. He said that most people lose money because they want to trade on every small movement, whereas the real money is in catching the big trend. 3. Risk management and stop loss. Saving capital was the first priority for Gary Bielfeldt. He used to say, "You have to accept that you cannot be right every time." His method of placing stop loss was very systematic. If the market touched his predetermined level, he would exit without any emotion. 4. Capacity for big profits, or size of the win. Like a poker player, Gary knew that when you have aces, you should place a big bet. When he was completely sure that the trend was very strong, he would increase the size of his position. This was the quality that took him from $1,000 to millions of dollars. The biggest rule of success: patience. According to Gary, being patient is far more important in trading than being smart. The market will provoke you many times to take a trade, but a real wizard is one who sits quietly until the perfect opportunity arrives. Part 2. Mostly stocks. In this second part, Jack Schwager introduces us to those 5 masterminds who made the stock market dance on their fingertips. Here we will not just learn buying and selling shares, but we will learn those magical systems that caught ordinary companies turning into multi-baggers.
Chapter 6. William O'Neill, founder of Investors Business Daily. William O'Neill's thinking was completely different from the rest of the world. Where people looked for cheap stocks, O'Neill used to say that you should buy what is already performing well. He told Jack Schwager that money in the stock market is made only from those companies that have tremendous growth potential. Can Slim, that magical formula that made thousands rich. O'Neill has summarized his entire strategy in 7 letters, which is called Can Slim. Let us understand it in detail. C. Current quarterly earnings. According to O'Neill, the first signal is the company's latest quarterly profit, EPS. It should be at least 20 to 25% more than the same quarter of the previous year. If the profit is growing rapidly, that is a very strong positive signal for the stock. A. Annual earnings increases. Just one quarter's profit is not enough. There should be stability in the company. The company's annual profit should keep growing consistently over the last 3 to 5 years. O'Neill used to choose those companies whose annual return on equity, ROE, was more than 17%. N. New products, new management, new highs. A spark is needed to push the stock price upward. The company should have launched a new product, new management should have come in, or the stock price should be making a new high on its chart. O'Neill believed that stocks that make new highs often go even higher. S. Supply and demand. This is the simple law of economics. If the demand for a stock is very high and the number of its shares, supply, is low, the price will rise rapidly. O'Neill gave priority to those companies that were buying back their own shares from the market, buybacks, because this reduces supply. L. Leader or laggard. You should always bet on the leader stock of your industry. O'Neill used to use relative price strength, RS score. His rule was to buy only that stock whose RS score was 80 or above, meaning that stock was performing better than 80% of stocks in the market. I. Institutional sponsorship. Big money is what takes the stock higher. That stock should have at least some big mutual funds, banks, or large investors holding a stake in it. If big players are buying the stock, that is a signal of trust. Market direction. This is the most important rule. No matter how good a company you choose, if the entire market is falling, your stock will also fall. O'Neill used to say that always buy only in a confirmed uptrend, a rising market. When the market index starts going down, 75% of stocks also go down. O'Neill's strict rules of trading. Rule 1. Don't buy low, buy right.
O'Neill said something shocking to Jack Schwager. He said, "Most people buy a $20 stock because they think the $50 stock is expensive. But in reality, the stock that is making a new high at $50 has a far greater chance of becoming $100 than the $20 stock." Rule 2, the 7% stop loss rule, the golden stop loss. O'Neill had an unbreakable rule. Never let any stock go more than 7% below your purchase price. He used to say that if you cut your loss at 7 to 8%, you will always survive in the market. This is like an insurance policy for you. Rule 3, charts and cup with handle. O'Neill was a master of charts. He popularized a special chart pattern called cup with handle. He would look for stocks that after staying in a range for a long time would break their resistance and come out. Mental discipline, mindset. According to O'Neill, for success in the stock market, you will have to give up your ego and emotions. You should do what the market is saying, not what you want. He used to say 90% of people do not learn from their mistakes. They just keep hoping that their falling stock will come back up.
Chapter 7. David Ryan won the U.S. Investing Championship 3 consecutive years. David Ryan's story is an inspiration for those who believe that a magical formula is needed to succeed. He was a student of William O'Neill himself. Ryan did not discover anything new. He just applied the rules of CanSlim with such precision and discipline that he beat everyone in the U.S. Investing Championship of 1985, 1986, and 1987. 1. The strict process of selecting stocks, the filtering process. For Ryan, selecting stocks was like a filter. He would test thousands of stocks on these 3 levels. Step 1. EPS and sales growth. First, he would see whether the company's profit, earnings, was growing very rapidly compared to the previous year. If the profit was growing less than 30%, he would not even look at that stock. Step 2. Relative strength, RS. He would only choose those stocks whose RS score was 90 or above. This means that share is stronger than 90% of shares in the market. Step 3. Volume explosion. According to Ryan, when a share breaks out of its base and moves up, its volume should be at least 50 to 100% more. If the share is rising without volume, that is a deception. 2. Importance of chart pattern, looking for the base. David Ryan was considered crazy about charts. He always looked for shares that had stayed in a small range, sideways, for at least 7 weeks or more. He called this the base. He believed that the bigger the base, the bigger the jump. He specifically traded the cup with handle pattern because this pattern shows that weak investors have exited and now the stock is in the hands of big players. 3. Risk management, the 7% rule. Ryan told Jack Schwager that his biggest wins were not his profits, but his small losses. 7% stop loss. If any share fell 7% below his purchase price, he would sell it without any question. He used to say, "I never sit on hope. If the market says I'm wrong, I accept my mistake." Never averaging. Ryan considered putting more money into a falling share, averaging down, a sin. He used to say it is like setting money on fire. 4. Pyramiding, increasing the winning trade. Where ordinary people sell shares the moment there is a profit, Ryan did the opposite. If he bought a share at $100 and it reached $105, he would add a little more money to it. He would keep increasing his position as long as the trend remained strong. This is why his winning trades gave him so much profit that his small losses did not matter at all. 5. Ryan's daily routine, the hard work. The biggest secret to success that Ryan told was hard work. He would look at more than 2,000 charts every day after the market closed. He would do a post-mortem of every trade. He would write down why he took the trade, what went right, and what went wrong. He said trading is a full-time profession. If you do it for part-time fun, the market will full-time finish your capital. David Ryan's special tip. When the entire market index is going down, sitting quietly is the best trading. When the market turns back, the shares that make a new high first will be your next multi-baggers.
Chapter 8. Zoran Mattic, master of reading the market's mood. This is a trader whose story is very mysterious and impressive. Zoran Mattic was a player who had mastered the art of recognizing the market's behavior, market behavior. Mattic believed that the market is not just a game of numbers or charts, but it is a large group of human emotions. He considered charts not just as lines, but as the battlefield between buyers and sellers. Method of analysis: price is God, price action. Mattic was among those traders who trusted price action more than indicators, RSI, MACD, etc. He would see how the market was reacting at a particular level. He used to say that if the market does not fall despite bad news coming, then it should be understood that the market has tremendous strength. He often used to catch false breakouts. If the market makes a new high and immediately falls back from there, Mattic considered it a big signal of a bearish trend. Trading style: mix of aggression and restraint. Mattic's trading style was very focused. He did not trade at all times. Art of waiting: he could sit quietly for weeks until he saw the pattern he liked. Attacking at the right moment: the moment he found a setup where risk was low and reward was very high, he would take a very aggressive large position. Risk management: knowing your limits. Mattic told Jack Schwager that the most important thing in trading is knowing when you're wrong. He would decide his exit point before taking the trade. He believed that if a trade is not showing profit immediately after taking it, it means your timing is wrong. In such a case, he preferred to exit immediately. Zoran Mattic's definition of a successful trader. In this chapter, Mattic said something very deep. An average trader always wants to know where the market will go, while a successful trader sees what the market is doing right now. Flexibility: if Mattic felt he was wrong, he would not take a second to reverse his position, going from long to short. He never fell in love with his ideas. Discipline and solitude. Mattic preferred to do his research alone. He believed that listening to others' opinions weakens your own analysis. He advised Jack Schwager that a trader should develop his own methodology and remain firm on it. Zoran Mattic's key takeaways: recognize the market's tone. Pay attention to the market's reaction more than the news. Importance of timing: play big only at the right time. Accept mistakes. When wrong, exit immediately. Do not bring ego in between. Keep it simple. Focus on pure price action rather than too many complex indicators.
Chapter 9. Mark Ritchie, Master of Screen Trading. This is someone who had seen the most difficult period of trading. Mark Ritchie's story is an example for those who believe that trading is only a game of mathematics. Ritchie started from the noise of Chicago's trading pits, where deals were done by screaming, and later became a master of trading on a computer screen sitting in a quiet room. Mark Ritchie's beginning was very ordinary. He was a religious and philosophical person who kept his trading also based on principles. He told Jack Schwager that success in trading does not mean just making money, but gaining control over your fear and greed. 1. The pit experience, floor trading. Trading in Chicago's pits was like a battlefield. There, you had to be very sharp physically and mentally. Ritchie learned there how to feel the market's movement. He saw that when everyone is panicking and selling, that is often the best opportunity to buy. He understood the intricacies of arbitrage, buying cheap from one place and selling expensive at another place. 2. Transition to screen trading. When trading moved from pits to computer screens, many old traders were ruined because they could not change, but Ritchie changed himself. He realized that on the screen you have to trust data and logic more than the information visible to you. He based his strategy completely on discipline. 3. Ritchie's main strategy: risk management. Mark Ritchie has a very famous thought: most people take a trade thinking about how much money they will make, while I take a trade thinking about how much I can lose. He never placed a bet that would put his trading career at risk. He waited for the big trade, but while keeping his capital safe. He believed that if you stay in the game, profit will happen on its own. 4. Trading and philosophy. Ritchie did not consider trading as gambling.
According to him, logic versus emotion. If you have no solid reason to take a trade, you are just gambling. Acceptance of win and loss. He taught that losing is part of trading. Just as a shopkeeper pays money to buy goods, similarly, a trader pays the learning fee through stop-loss. 5. Advice for common traders. Mark Ritchie told Jack Schwager that people fail because they want to become rich overnight. He advised to start small and not increase your position until you start making consistent profits. He called hurry the biggest enemy of trading. Mark Ritchie's wizard mantras. Capital is everything. If your wallet is empty, you are out of the game. Do not tell the market what to do. Do not tell the market where it should go, but follow wherever the market is going. Honesty. Be honest with yourself. If you are making a mistake, admit it immediately.
Chapter 10. James B. Rogers, Jr., co-founder of the Quantum Fund. This is an investor who does not find opportunities in the lines of charts, but in the world map and the big changes in the economy. Jim Rogers, who along with George Soros founded the Quantum Fund, earned an incredible return of 4,200% in 10 years. Jim Rogers' investment style was like that of a detective. He would not just sit in the office watching a screen, but he himself would travel to the countries where he wanted to invest. He believed that if you do not see the world up close, you will never be able to recognize the big trends. 1. The mathematics of supply and demand. Rogers' entire philosophy rested on one thing: supply and demand. He used to say that if the demand for something is very high and its supply is decreasing, its price is bound to rise. He made heavy profits in commodities like crude oil, gold, agricultural products, because he recognized that there was going to be a shortage of these things in the world. 2. Global macro analysis. Rogers kept a close eye on the politics of countries, wars, changing governments, and interest rates. Recognizing change. He would look for countries where economic policies were very bad, but were now about to improve. He used to say, when everything in a country has become very bad, there is only room for improvement from there. That is the right time to invest. 3. Buying at the bottom and patience. Rogers can also be called a value investor. He would invest when any sector or stock had been abandoned as garbage. His famous dialogue is, "I wait until the money is lying in the corner and I just have to go and pick it up." This means he would not take a trade until the probability of winning was close to 100%. 4. His view towards charts. Unlike William O'Neill or David Ryan, Jim Rogers did not trust charts much. He used to say that charts can tell you what happened yesterday, but they cannot tell you what will happen tomorrow. For him, fundamentals was everything. 5. Jim Rogers' advice for common investors. In the interview with Jack Schwager, Jim Rogers said some bitter but true things. Do not become part of the crowd. When everyone is talking about something, understand that it's time to exit from there. Knowledge is power. If you do not know 100% about something, don't put even a single dollar in it. The difference between laziness and patience. Sitting quietly and waiting for the right opportunity is not laziness, but a great investment strategy. Jim Rogers' wizard principles. Keep an eye on commodities. The world will always run on food, energy, and raw materials. Catch governments' mistakes. Governments often make wrong economic decisions. That is the opportunity for investors to make money. Leave the ego. If you have made a wrong investment, accept it and exit. Part 3. A little bit of everything. The name of this part itself tells us that here we will meet those all-rounder legends who did not let the wall of any one market become a barrier for themselves. These are those traders who made their mark in complex areas like options, treasury bonds, arbitrage, and global macroeconomy. Chapter 11. Mark Weinstein, the extremely mysterious trader with a winning rate of nearly 99%. Mark Weinstein's chapter is considered the most unique in Market Wizards. He was one of those rare traders who were successful in almost every type of market: stocks, futures, options, and commodity. His biggest identity was his 99% success rate, which he called reading the language of the market.
The basic foundation of Weinstein's trading was that he was not a gambler, but a strategist. He would sit quietly until he was sure that the market had given the signal of its move. 1. Confluence of indicators. Weinstein would not take a trade by trusting any one indicator. He would use many different chart tools at the same time. Multi-time frame analysis. He would first look at the bigger chart to know the direction, and then take entry on the smaller chart. Elliott wave and Fibonacci. He understood the waves of the market. He would see whether the market had completed its correction. Volume and momentum. If the price was going up but volume was low, Weinstein would understand that this rally was fake. 2. Catching the market's lie, or non-confirmation strategy. Weinstein's biggest specialty was catching divergences. If the market makes a new high, but momentum indicators like RSI are not making a new high, he would understand that the market is tired. He was a master of false breakouts. If the market breaks a resistance and goes up and immediately comes back, he would take a big bearish position from there. 3. Risk management, strict hatred of losing. Most traders are happy being right 50 to 60% of the time, but even a 1% loss stung Weinstein. Immediate exit. He believed that if a trade is not showing profit immediately after taking it, it means his timing is wrong. He would cut the trade without thinking. Protection of capital. He used to say, always protect your capital like a woman who has no one to protect her. 4. Mental discipline and solitude. Weinstein told Jack Schwager that he would not listen to any other trader or news channel. Own research. He would stare at charts for hours until the charts started talking to him. Giving up ego. Weinstein used to say that the trader who thinks he's bigger than the market brings him to the street very quickly. He always remained humble before the market. 5. Weinstein's 5 golden rules, the full breakdown. Homework. Before the market opens, you should have a complete plan. Trading without preparation is suicide. Think against the crowd. When everyone is scared, look for opportunities, but do not jump until the chart confirms. Patience. Weinstein often would not trade for weeks. He used to say, the market will always be there, but your money will not. Flexibility of strategy. If the market is changing, change your strategy. Do not follow the same old pattern. Never overtrade. Taking too many trades destroys concentration. Conclusion: mark Weinstein's biggest lesson. Weinstein's chapter makes us understand deeply that trading is a game of waiting. A successful trader is not one who wants to make money on every movement, but one who attacks only when the win is certain. Chapter 12. Brian Gelber, expert in Treasury bonds and interest rates. Brian Gelber was one of those rare people who completed the journey of being a successful broker as well as becoming a great trader. He was one of the most respected persons at the Chicago Board of Trade, CBOT, and his perspective in the Treasury bonds market was considered set in stone. Brian Gelber, the strategist of the bond market. Gelber's specialty was that he did not rely only on charts, but he had a deep understanding of the market's flow. He knew when and why big institutions were trading. The difficult journey from broker to trader. Gelber told that there is a world of difference between the mindset of a broker and a trader. Broker's perspective. A broker always wants there to be movement in the market so that he gets commission. Trader's perspective. A trader has to stay calm and wait for the right opportunity. It took Gelber quite some time to give up his broker habits, because in the beginning he was making the mistake of trading on every small movement. Market sentiment and collective psychology. The biggest part of Gelber's analysis was reading the psychology of the market. He would see how the market reacted when important economic data like inflation or unemployment data came. If the news was very good, but bond prices were not rising, he would understand that the bulls, or those in favor of rising market, in the market were tired, and now a bearish trend was coming. 3 main conditions of trading. Before entering any trade, Gelber would look for the convergence of 3 things. Fundamental. What is the condition of the economy and what is the direction of interest rates? Technical. Where are the support and resistance on the charts? Psychological. Is the market too overbought or oversold? Are people scared or greedy? Risk management. When in doubt, get out. Gelber believed that a trader's biggest asset is his clear thinking. He told Jack Schwager, "The moment I have doubt about my trade or I do not understand what the market is doing, I immediately cut all my positions." He never argued with the market. For him, stop loss was not just a number, but a discipline. Recognizing the cue of big traders. Being a former broker, he knew that when big commercial banks or governments enter the bond market, the direction of the market changes. He often preferred to go against small traders and with big institutions. Brian Gelber's deep lessons. End of ego. The market will humble you. If you are not humble, the market will break you. Gelber admitted that his biggest loss happened when he stuck to his opinion. Effect of interest rates. He believed that interest rates are the center of the entire world's economy. If you understand the bond market, you can also understand the stock and currency market. Discipline is success. According to him, despite having an excellent system, 90% of people fail because they do not have the discipline to stick to that system. Conclusion. Brian Gelber's chapter teaches us that having knowledge and trading correctly on that knowledge are two different things. A successful trader is one who keeps his knowledge above his ego.
Chapter 13. Tom Baldwin, one of the biggest pit traders at the Chicago Board of Trade. This chapter takes us to that era of trading when deals were not done on computer screens, but in a noisy pit, a round arena, by screaming and hand signals. Tom Baldwin was the biggest warrior of this arena. He started with just $25,000 and became the biggest individual player, making deals worth billions of dollars in the bond pit of the Chicago Board of Trade. Tom Baldwin, the giant of pit trading. Baldwin was a local trader. Locals were those traders who traded with their own money and provided liquidity to the market. His job was to buy and sell hundreds of times a day for small profits. 1. A big risk and a tremendous start. Baldwin had started trading without any experience. He had only $25,000, and at that time, the rent of a seat, or right to trade, alone was $2,000 per month. He had no other option but to succeed. The secret of his success was his being fearless. He never hesitated to trade in very large quantities. 2. The psychology of the market pit. In pit trading, you had to look into the eyes of the person in front of you and recognize whether they were scared or not. Baldwin told Jack Schwager, "Contrarian thinking. When everyone in the pit was screaming together, 'Sell, sell,' Baldwin was often standing alone and buying. He knew that when the crowd is excessively scared, that is the time for the market to turn." 3. Risk management. Learn to embrace the loss. Most people panic when there is a loss, but Baldwin's perspective was different. He used to say, "The cost of trading is the loss." Just as for a shopkeeper, rent and electricity bill is an expense, similarly for a trader, stop loss is an expense. His rule was, if the trade is going wrong, exit without wasting a single second. Arguing with the market means inviting your own ruin. 4. Edge and discipline. Baldwin believed that a successful trader should have some edge, i.e. advantage in the market. His advantage was his patience. He would stand for hours waiting for the right price. He said that 90% of traders fail because they overtrade or they do not have enough discipline to keep their losses small. 5. Identifying big traders. Baldwin said something deep, that when big banks or institutions come into the market, they leave their mark. He would see whether big traders were buying with strength or with weakness. He always tried to go with the big flow, even if they were against small traders. Tom Baldwin's main trading principles. Money is your weapon. Keep your capital safe, because without money, you cannot step onto the battlefield. Emotional neutrality. Whether there is a big profit or a big loss, your face should remain the same. A decision taken in the grip of emotions is always wrong. There is no substitute for hard work.
Baldwin would stand in the pit from morning to evening. He believed that the more time you spend in front of the screen or pit, the deeper your understanding of the market will be. Conclusion. Tom Baldwin's story teaches us that trading is not just a game of the mind, but a game of the heart. A successful trader is one who remains calm even under pressure and stays on his plan.
Part 4. The view from the floor. This part will teach us that no matter how much technology changes, the real battle of the market is always fought between discipline, mathematics, and emotions. Chapter 14. Mark Ritchie, The Intricacies of Arbitrage. Mark Ritchie was not an ordinary speculator. He would go into the market not to gamble, but to find inefficiency. He believed that if there's a difference in prices between two similar markets, money can be made there without any big risk. Number 1. What is arbitrage? The simple meaning of arbitrage is buying the same thing cheaply from one market and selling it expensively in another market at the same time. Example in pits. Ritchie would see that if the price of soybean was slightly lower in one trading pit and slightly higher in a related contract, he would take trades on both sides and make that spread his profit. Low risk, high precision. It does not matter whether the market goes up or down. What matters is only when the difference between the two prices will end. Number 2. The pressure and discipline of pit trading. Thousands of people would be screaming together in the pits of Chicago's Board of Trade. Ritchie learned two biggest things here. Emotional control. Ritchie used to say that the trader who loses his composure in the screaming and noise makes mistakes. He had completely numbed his emotions. Quick decisions. Arbitrage opportunities would come for only a few seconds. Ritchie's mind worked like a calculator that would immediately calculate profit and loss. Number 3. Ritchie's trading philosophy. Small loss, big life. Ritchie believed that to stay in trading, you will have to learn to lose. He used to say that the biggest mistake in trading is that people do not accept their loss. They hope that the market will come back in their favor. For Ritchie, stop loss was a protective shield. He used to say that if you cannot cut your small losses, the market will soon give you a big loss that you will not be able to bear. Number 4. The mantra of success. Stay on logic. Mark Ritchie told Jack Schwager that there is no magical formula for his success. Trust the system. He would only take those trades that had a solid logic behind them. Different from the crowd. When everyone in the pit was running in the same direction out of fear, Ritchie would stay calm and take advantage of the crowd's foolishness. Number 5. Balance between life and trading. Mark Ritchie was a philosophical person. He said something very deep in this chapter. Making money can be an objective, but it should not be the meaning of your life. He never kept his trading above his family or morality. He was one of those rare traders who could maintain mental peace even in the midst of the market's hustle and bustle. Deep lessons from Mark Ritchie. Look for low-risk setups. Do not trade at all times. Step in only when the risk is minimum and the possibility of profit is clear. Respect the market. The market is never wrong, only your perception can be wrong. Concentration. Understand the difference between noise and information. In the noise of the pit, Ritchie paid attention only to the useful prices. Conclusion. Mark Ritchie's chapter teaches us that arbitrage is not just mathematics, but an art in which you have to maintain the right balance of patience and agility. His story proves that a small effort done with discipline can also build a vast empire over time.
Chapter 15. William Eckhardt, the famous turtle trading experiment. Where Richard Dennis was an intuitive trader, Eckhardt was a mathematician. A famous debate had taken place between these two. Can trading be taught, or is it an innate quality? From this very debate was born the world's most famous turtle trading experiment. William Eckhardt, the scientist of trading. Eckhardt believed that human psychology is not at all suitable for trading. According to him, to win in the market, you will have to go against those emotions that make you feel safe. 1. The foundation of the turtle trading experiment. Richard Dennis believed that he could make anyone a successful trader, while Eckhardt had doubts.
They chose a group of ordinary people like musicians, actors, gamers, gave them 2 weeks of training, and gave them money to trade. Result? Those turtles earned millions of dollars in the next few years. Conclusion: Eckhardt accepted that with discipline and the right rules, system, anyone can succeed. 2. Human intuition is the biggest enemy. Eckhardt told Jack Schwager that the things that seem right to us are often wrong in trading. Buying cheap, selling expensive, common people think that buying a falling share is safe. Eckhardt used to say that this is dangerous. He would buy on breakout, meaning when the share had already become expensive and was making a new high. Taking small profit, it is human tendency to book profit as soon as a little profit shows. Eckhardt taught that for big winners, you will have to let your profit grow. 3. Risk management and the N rule. The most important thing for Eckhardt was protecting his capital. In the turtle system, he used N. He would see how much a share goes up and down on average in one day. According to that, he would decide his stop loss and position size. His rule was never put more than 1 to 2% of your total capital at stake in one trade. 4. Statistical edge. Eckhardt used to say that you do not need to win every trade. If you lose 7 out of 10 trades and win only 3, even then you can become a millionaire, provided your 7 losses are very small and your 3 profits are very big. He called these fat tails or black swan events. When a very big trend comes in the market, that is what makes all the money. Eckhardt's deep insights. Pain and profit. Successful trading can be physically painful. The trade that scares you the most to take is often the one that gives the most profit. Trust the system. If you have a tested system, do not apply your own intelligence. Follow the system, even if you feel the market will fall. Fear of loss. People are so afraid of losing that they don't accept their loss. They keep sitting in hope, and this becomes the cause of their end. Conclusion. William Eckhardt's chapter teaches us that trading is not a game, but a science. Keeping your emotions on the shelf and strictly following mathematical rules is what turns an ordinary person into a market wizard. Part 5. The Psychology of Trading. Chapter 16. Dr. Van K. Tharp, a famous trading psychologist. Tharp believed that the market is a mirror. Whatever you feel inside, fear, insecurity, greed, the market reflects it in your trading account. 1. The psychology of beliefs. Tharp said something revolutionary. He said there is no such thing as a market in the world. There are only people's beliefs that take prices up and down. Truth versus perception. You buy a share because you believe it will go up. If your belief turns out wrong and you do not cut the trade, you are not fighting the market, but your own ego. Belief of a successful trader. A wizard's belief is that I can lose, but my system will win in the long run. 2. R multiple and profitability. Tharp connected mathematics with psychology. He gave the concept of R. Initial risk R, the money you are willing to lose before taking a trade, stop loss, is 1R. Expectancy. Tharp used to say that you should know that after 100 trades, how much R does your system earn on average per trade? Conclusion. To succeed, you do not need to be 90% accurate. If you cut your loss at 1R and let your win go to 3R or 5R, you can become a millionaire even with 30% accuracy. 4. Position sizing, the real engine of success. According to Dr. Tharp, most traders focus on what to buy, while success depends on how much to buy. The gambler's ruin. If you have $100,000 and you take a risk of $20,000 in one trade, then 5 consecutive losses will finish you. The wizard's rule. A wizard never puts more than 1% or 2% of his total capital at risk, 1R. This way he stays in the game even after losing continuously. 5 mental barriers of trading, psychological barriers. Tharp identified those mistakes that sink even good traders. Not accepting loss. We learn from childhood that losing is bad, but in trading, losing is the cost of business. Cutting profit in haste. Out of fear, we book small profits and leave the big winners. Lottery mentality. The desire to make too much money in less time makes you a gambler. Lack of rules. If you don't have written rules, you will change your strategy with every wave of the market. Lack of responsibility. The trader who says the market robbed me can never improve. 5. Training for peak performance. Tharp used to teach traders stress management and visualization. Mental rehearsal. Before taking a trade, imagine how you will calmly exit if the stop loss is hit. If you are mentally prepared for loss, you will not make a wrong decision out of fear. Trading journal. Don't just write the price, but write what was going on in your mind at that time. Were you excited? Did you want to take revenge? Revenge trading? Dr. Tharp's biggest lesson. A successful trader is one who has killed his emotions and follows his system like a robot. He does not worry about the result, he only worries about his process. Conclusion. Dr. Van Tharp's chapter turns us from a trader into a professional risk manager. It teaches us that money is made not from charts, but from discipline and self-control.
Chapter 17, the postscript. This chapter is the most valuable part of the entire book. Here, Jack Schwager, after interviewing these legends, has connected those threads that were common in all these wizards. Whether someone was a fundamental trader or technical, traded in bonds or stocks, behind the success of all of them were 42 golden rules. Here is the complete description of those 42 golden rules, divided into categories for easy understanding. Category 1. Preparation and mindset. Rule 1. Trading is not an easy path. It is a difficult profession. Hard work is necessary for it. Rule 2. Identify your edge. You should have a strategy that is precise. Rule 3. Find your own style. Do not copy others. Trade according to your own personality. Rule 4. Trading is a business. Run it not like a hobby, but like a business. Rule 5. Self-confidence. You should have complete trust in your strategy and decisions. Rule 6. Extreme discipline. Without discipline, even the best strategy is useless. Rule 7. Independent thinking. Do not become part of the crowd. Do your own research. Rule 8. Desire to learn. The market always changes. You will have to be ready to learn something new. Rule 9. Patience. Waiting for the right opportunity is the biggest skill. Rule 10. Hope is not a strategy. Never hold a trade on the basis of hope. Category 2. Risk management, most important. Rule 11. Learn to accept loss. Taking a small loss is part of trading. Rule 12. Protection of capital. Your first goal is not to make money, but to save your capital. Rule 13. Use of stop loss. In every trade, an exit point should be decided in advance. Rule 14. Take small risk. Never put all your capital at stake in one trade. 1 to 2% rule. Rule 15. Position sizing. Decide the quantity of shares according to your capital, not according to emotions. Rule 16. Never average down. Putting more money in a falling share is suicide. Rule 17. Let profits grow. When you are right, hold it until the trend changes. Rule 18. Increase winning trades. Pyramiding. When there is profit, learn to increase the position. Rule 19. Diversification. Do not put all money in one place. Rule 20. Risk and reward. Only take those trades where the potential profit is much more than the risk. Category 3. Trading rules and process. Rule 21. Do not argue with the market. The market is never wrong. Your opinion can be wrong. Rule 22. Go with the trend. Trend is your friend. Do not go against the flowing wind. Rule 23. Importance of breakout. When the market breaks a big range, there are big opportunities there.
Rule 24, simple system. The simpler the system, the more effective it will be. Rule 25, do not react to news. Pay more attention to the market's price action than the news. Rule 26, avoid overtrading. It is not necessary to trade every day. Rule 27, wait for good setup. Until your system says yes, do not make a move. Rule 28, timing. Along with the right price, it is necessary to enter at the right time. Rule 29, trade alone. Others' advice weakens your decision. Rule 30, keep records, journal. Write down every trade and learn from your mistakes. Category 4, mental and emotional control, psychology. Rule 31, keep emotions away. Keep fear and greed away from the trading desk. Rule 32, remove the fear of losing. If you are afraid of losing, you will never be able to take the right trade. Rule 33, take full responsibility. Do not blame anyone else for your loss. Rule 34, stay calm. Whether there is a big profit or a big loss, do not lose mental balance. Rule 35, wins and losses are independent. No matter how the previous trade was, do not let its effect fall on the next trade. Rule 36, do not do revenge trading. Do not take a big risk in the effort to recover the loss. Rule 37, understand the nature of the market. The market is not always logical. Rule 38, stay happy. If trading is giving you stress, take a break. Rule 39, stick to the plan. After taking a trade, do not change your plan in between. Rule 40, visualization. Before taking a trade, prepare yourself for every situation, win or loss. Rule 41, give up ego. The market knows how to humble you. Stay humble yourself. Rule 42, consistency. Instead of becoming rich overnight, focus on growing slowly and continuously. I have created a PDF of these 42 rules and given the link in the description. You can download it from there. These 42 rules are like a holy book for any trader. Jack Schwager says that if you strictly follow these rules, then you can become part of the top 5% traders in the world. I hope the stories of these legends have given a new direction to the trader inside you. It takes us weeks of hard work to create this kind of research-based content so that you can get the knowledge of thousands of pages in just a few minutes. If you feel that your knowledge increased even by 1% today, then please make sure to like this video. Your one like and subscribe tells us that we should keep doing this kind of hard work for you. In the next video, we will decode the book that changed the life of the world's greatest trader, Warren Buffett, a book that contains many secrets of the stock market. If you want to join us on this journey of financial freedom and do not want to miss the summaries of these upcoming valuable books, then subscribe right now and press that bell icon. Make sure to write your favorite chapter number in the comments so I know that you were with me till the end of the video. Keep learning. I will see you in the next masterclass. You are watching Inside Wealth Files.